and welcome to the July Buy-to-Let Mortgage Market Update. My name is Richard Pennell from The Mortgage Home, and we are your buy-to-let mortgage experts. So what have we got in store for you this month? Well, we've got 4 pieces of content. As always, I'm going to talk about the Bank of England interest rates and what the impact might be on mortgage. And of course, we've had the election this time round, which leads me on to my second piece. We've now, like it or not, we've gone from blue to red, and we've got a Labour government in town. So I've been going through their promises, their manifesto, and just pulled out what is likely to be the impact on landlords. So if you've got an interest in that, then stay tuned for that second piece. Now, my last 2 pieces, it's all about saving money. Is there a bad time to save money? I don't think so. So, first of all, who wants to reduce the interest they're paying on their mortgage? Now, whether that's residential or buy-to-let, I want to talk to you about a particular type of mortgage product that will save you interest on those mortgage payments. So that should be of interest to almost everybody. And finally, could you have your life insurance premium? Surely not. Well, today, I want to talk to you about a really exciting type of life insurance policy. You've got to be able to qualify, so tune into that chapter and see if you do, and then I'll explain how you actually make those savings. So let's get on with it. So in Market Watch, here we are. I'm recording this on the 9th of July, and we're at 5.25% still. We've been there for such a long time. Now, of course, in my last month's update, I said, particularly with the election coming, even if all the ducks were lined up for a rate reduction, I didn't see the Bank of England pressing the button. They didn't. And so now we got to wait for the next meeting. So the question, of course, on everybody's lips, particularly with inflation now being at 2%, which is the Bank of England's target. And in simple terms, they said when we're hitting those targets, we should be looking to reduce rates. So, of course, we were expecting the Bank of England to do so. But do you know what? I'm not 100% sure. We've got the next Bank of England meeting on the 1st of September. So, yes, the headline inflation is at 2%. But, of course, it's more complex than that. It's more the Bank of England are going to get under the surface of inflation and look at all the component parts. And I'm not sure just yet that all those individual elements of inflation, in particular wages inflation, are going in the right direction. So there's some more data, more reports coming out in about the next 10 days that I think are pivotal to the Bank of England's decision on the 1st of September. So do not be surprised if they don't press the button at the next meeting. Hopefully, if not for September, it will be in October. Look, I'm really hopeful. I think it's still likely that there's going to be a drop, but I wouldn't be surprised if the Bank of England pause it for another month. And here's why. The last thing the Bank of England want to do is to jump just that little bit too early, drop rates in on the 1st of September, and then find they've got to reverse that because some of the little worrying niggly parts of inflation are actually starting to go in the wrong direction. And then they've got to all of a sudden reverse that. That will send absolute chaos across the financial markets with this flip-flop approach from the Bank of England. So the one thing we should be reassured of is once the Bank of England do press the button, because of their prudent nature, I think then we will be on that trajectory of further rate cuts towards the end of this year and into 2025. So what's been the impacts with the election? Well, certainly, I think some really great news. You may have seen it already, but we've got high street banks now really jockeying for position. They've got more certainty. They know the government that's in town. Even though the Bank of England rate hasn't dropped, they're actually cutting their margins again, and it's getting more competitive. So that's great news. If as a landlord, you're still able to get your buy-to-let mortgages from the high street. And that, in essence, usually means that your portfolio is 10 properties or less. If you're now about to hit that 10 or you're above it, you'll already know you're not going to the high street lenders. You're now with the secondary market. The sort of rate cuts I'm seeing, about 0.2, 0.3% generally speaking. But Barclays, wow, what are Barclays doing? They're having a fire sale. 0.7% reduction on their rates. Amazing. So might you qualify for Barclays? Again, I looked at their policy before I came on air today. They'll allow portfolio landlords with up to 10 properties, which is about as good as it gets for high street banks. So you might still be eligible to get some Barclays buy-to-lets there with some great savings. Now, what's the impact on mortgages in the wider field looking forward? Well, as I said, we've already got the high streets starting to cut rates, and I think they'll cut them even further once the Bank of England presses the button and drops the Bank of England rate, which will be 0.25% when they first start to drop rates. The secondary market, so these lenders that are not banks, not building societies, then these guys are not yet moving. They will need to wait until there's actually some rate cuts and the wholesale market's starting to drop their rates, and then they can pass that on to you. So we've definitely got these two camps, two categories. The high street lenders already starting to move and drop rates down, which is great news. But sadly, if you're a larger portfolio landlord, i.e. above 10 properties, then we're not seeing really any significant changes in rates. But I do expect that as we get into autumn. Takeaway message. Well, really, I'm thinking of you guys who are, you've got a fixed deal. It's come to the end in the next few months, and it's whether you hold tight or you start to get the research done and get applications in. For me, I don't see a downside at all in getting your application in right now. Even if rates are going to drop in the next month or two, you can always secure the rate today because, look, if we've learned anything with Liz Truss and other things coming in left field to really turn the market on its head, then if we've got those rates locked in now and for some reason rates start to go back up, not that we're expecting it, but we've already locked in the best rates we could have got. But if rates continue then to drop further between now and when your deal ends, as a broker, we can then get those even better rates. Even though we've locked in the rate today, if rates drop, we can go back to the lender and ask for that improved rate. So it's a win-win. So therefore, if with my landlord hat on, I will be putting your application in right now. And if you want to talk about your circumstances a little bit more, then there'll be a link under this page. Just click on that, book some time in with a team, and let's see what rates are out there that are applicable to you. In this piece, I want to talk about the new Labour government we've got in town. Of course, we've gone from blue to red. Like it or not, we've got the Labour government now with us for the next 5 years. So what does that mean for landlords? Well, I've been through their manifesto and what some of their promises and trying to tease out those that are relevant for us as landlords and just share a little bit of my view with you this morning. So the first of all, we've got their headline grabbing number of 1.5 million new homes. Now, this is over the next parliament. So we're talking about 5 years here. That's still 300,000 homes a year. But here's the thing. The governments of the past have never hit those targets that they've set themselves. So this is really ambitious by Labour. And are they even going to get close to that? So what are they going to do differently? Well, they've already started. I heard Rachel Reeves yesterday talk about relaxing local planning rules so we can get more of those applications through. There's the national planning regulations that are being overhauled. They're investing in 300 new planning officers. So for those of you that are doing developments and need those planning approvals through, then, you know, in maybe the medium term, we're going to see a speeding up of those applications, hopefully going through. There's going to be a focus on brownfield sites. It's been said before, but hopefully this time, perhaps there'll be funding grants for those developers that are in that area. Again, we've got to wait and see the detail on that for sure. But yeah, 1.5 million new homes. Let's see if Labour can deliver on that one. The one caveat that does worry me a little bit, and I'm sure if any developers are watching this today, is because it is Labour now in town, will there be affordable and social housing and I'm sure they will be written into any of the approval and the planning process, because they will be wanting to drive that through. But then does that make the project viable for you as a developer? Yeah, I guess we'll have to wait and see. Help to Buy, it's a phrase that's been around for a lot of years. The Tories used that to facilitate first-time buyers getting on the mortgage market. So Labour have got their equivalent called Freedom to Buy. It's pretty much similar. It's low deposit. It still doesn't sort the issue of affordability. It's all right saying, right, you don't have to find a deposit of more than 5%, but you've still got to afford the 95% mortgage. So particularly those first-time buyers in the southeast, that's an issue that it will never be resolved. I think without guarantors or some other innovative way. And again, maybe that's where affordable housing starts to play a bigger part down there. One other addition in this Freedom to Buy that might have an impact, if you were a landlord, I'd be really interested actually in the comments section, if as a landlord, your strategy is to buy new builds, then what the Labour government have said with Freedom to Buy is that they will force developers to offer new builds to first-time buyers only to start with. And only if first-time buyers don't buy those properties, they'll then be opened up to everybody else, including landlords. So, how do you feel about that if you're a landlord? Now, I put corporation tax on here because, of course, as far as I can see, about 1 in 2 applications nowadays for a mortgage is done in a limited company. And therefore, limited companies pay corporation tax. And of course, Section 24 has driven, I think there's about 60,000 SPVs, that's special purpose vehicles, which is the name given to those limited companies that hold investment properties, have been set up in recent years. So corporation tax is of interest to all us landlords that own a limited company. And it's good news there. It's good news in that the Labour government are not going to be targeting landlords, because obviously we've been driven away from owning them in personal name due to Section 24, and we've found this haven within the limited company environment. So, it could be an easy target for any government to start to attack landlords that have limited companies, but Labour have not said anything about that at all. So that is good news. The second bit of good news is that they've promised to keep the corporation tax cap at 25%, which is what the Tories had. So you tend to think Tories being pro-business and maybe not so much with Labour, but Labour have come out and said that they're not going to mess about with corporation tax limits. So a little bit of positivity there. Stamp duty, not a lot of change when it comes to landlords. Sadly, we've still got that additional 3% stamp duty bill to pay. There's been some tweaks when it comes to foreign investors. So if you're non-resident and you're buying an investment property in the UK, then you're going to get penalised even more. So the stamp duty bill is going up for you guys. I think that's obviously quite a niche area. And then there's this other area, again, not affecting landlords, but just talking more broadly about stamp duty, is that the exemption on stamp duty for first-time buyers comes to an end next March. And right now, the Labour government have not said that they're going to extend that. I would find it odd if they don't, because they're trying to encourage, buying of new homes and that ambitious target I talked about a little earlier. So if they're then increasing the stamp duty bill, or allow that to come back in next year, then that flies in the face of trying to hit these targets. So I would not be surprised if there's some extension of the stamp duty exemption as we head towards March of 2025. Now, I know a lot of you guys that watch my updates would be holiday let owners. And of course, when we had the Tory government in, we were expecting licensing to come into play in England. And of course, that got canned with all the election. As far as I can see, Labour will continue to bring licensing in to England. So expect that to come in. Here's the thing that we've got to wait to see, because the Conservatives did say that all existing holiday lets would be granted that new usage class, that holiday let class that was going to come into play. And it was only new applications that would be subject to a decision by the local authorities. So I'm waiting as a holiday let landlord myself for the Labour government to come out with a detail to see if they're going to be honouring that same thing. It'll be chaotic if they don't, but we don't yet know whether they will allow all existing holiday lets to be automatically moved into that classification. I really hope that the Labour government go down that line. Now, Renters Reform Bill, it got canned literally, didn't it, at the last minute before the election was called. It was pretty much the last bill that would have been enacted. And of course, now we've got the Labour government in town. Then, sadly, and again, please comment if you think otherwise. But I think the majority of landlords, are not happy about the Renters Reform Bill. It transfers more powers to tenants. Again, some landlords might say that's a good thing, that it equalises it. Many others think that it's taking powers away from landlords. So we've got a number of things going in there. The no-fault eviction is probably one of the biggest things, and that's going to come in fairly soon, I'm sure, from the Labour government, that we can't evict a tenant just because you want to sell the property. In addition to that, it looks like the 2-month notice period that landlords currently have to give might go to 4 months. And here's quite a worrying thing, if it does come through, is talking about rent caps. I think that will be absolutely chaotic. It's been tried elsewhere. It's failed miserably. Rather than the sort of self-regulation between, the competitive nature of this market should be allowed to run its course. Will Labour bring in some sort of rent caps? I really hope so. But again, if you've got a view, I'd be interested to hear what your thoughts are on that one. And here's the last thing, EPCs. Who thought I'd be talking about EPCs? Last autumn, the Conservatives eventually, and thankfully, in my opinion, put it into the long grass. Not because in principle I'm against energy efficiency and improving the housing stock and the green improvements that come with that. Absolutely. It was the ridiculous timeline that the Tories tried to impose on landlords to improve the rating up to that minimum. Do you remember they wanted us to have a C rating for new tenancies on 2025 and existing tenancies for 2028, which meant millions and millions of pounds of our money having to go into the housing stock to bring that rating up to C. And eventually it was ditched because, frankly, it was untenable. Now, the Labour government is saying we're going to bring it back. Now, what is that going to look like? We just don't know. So as soon as I get some detail on that, then I will share that with you. So, look, this whole thing is really personal. How it's going to affect you depends on your strategy. It depends on your circumstances. But I really would love to hear how you think it's going to affect you in the comments below. And let's have a bit of a conversation about the manifesto and how it might play out over years to come. In this piece, I want to talk about how on earth are we going to reduce our mortgage interest? Surely we can't be doing that, but yes, there is. There's a product out there. You see on the top line of my screen, it's the offset mortgage. Yes, I know it's not new, but there has been some innovation. There's been some new lenders come into this market, and therefore, as a broker, I've seen more and more, not only homeowners, but landlords jump onto this bandwagon. Why wouldn't they? If in their circumstances they could save money, reduce the interest of paying on the mortgages. It makes absolute sense. So I want to share that with you guys today and explain how you might benefit from this type of product. First of all, let's do a little bit of a rewind. For those of you that don't know how offsets work, it's quite simple. You've got a mortgage, let's call it a jar or a pot, a mortgage pot. You're borrowing £100,000. If it's an offset mortgage, then the lender also issues you with a savings pot. And the two pots are by the same lender, and therefore they are linked. They're separate but linked. So if you're borrowing 100K and you've got, let's say, £10,000 in your savings pot, then the computer recognises, of course, there's that money in the savings pot. The money is not moved. It's not reducing the balance of your mortgage that you owe. You still owe 100,000 quid. However, the interest you pay on that mortgage is not on 100,000. The computer goes, you've got 10 grand in your savings. We'll charge you interest on the net figure, £90,000. So therefore, you're paying less interest. And when you take your money out of the savings, it gets adjusted on a daily basis. So it's a very fair basis and set up in that way. Now, you might be shouting at the screen, what do you mean spare money? What do you mean, this extra £10,000 that I don't need? And I get that money for all of us can be quite tight. But I want to sort of challenge you about what I mean by surplus money. I'm not talking about profits that you don't know what to do with. I'm talking about your contingency money. That rainy day money that you've got to one side that you would not be spending on repairs and maintenance and living. It's not your working capital. It's over and above that. Now, if that is in your current account, if it's not working for you, then of course you can put it in this offset account, just have it sat in that jar, and now it's working for you. Do you have a trading company where you pay VAT over quarterly? If you are used to paying VAT, then you'll be putting that money to one side, hopefully, and then every quarter pay over to HMRC. I suspect that money is not working for you. Usually it's just in your current account or maybe off to one side in a savings account, but earning very little. Whereas now, if you put it in an offset, that money is working for you at 4, 5, 6% because that's what your mortgage rate's likely to be. What about your annual tax bill? Do you put money to one side for your annual tax bill? Again, trying to be smart about these little pots of money that you can aggregate and put into that offset account. And the final thing is working capital. Now, this could be a little controversial here, particularly if you're a limited company owner. And it does sometimes depend on the accountant that advises you. But I would certainly have a conversation, maybe even challenge your accountant. If you're a limited company owner and you've got I'm going to say surplus funds in your limited company account. I personally, because I do this, but I see no reason why within your accounting year, do not ever cross accounting years with what I'm about to say. Taking money out of the limited company and putting it in your offset account, as long as you then put that money back into the limited company before the year end, then it wouldn't be treated as a director's loan. Certainly as it crosses the year end. And I think actually if it does cross year end, your accountant is then meant to say, well, it has to be taken as dividends. And of course, there's all the tax implications. So as long as you put in that money back, there's a nice clear audit trail. You're taking X pounds out of your limited company account, put it into your personal account, and then put it back. There might be some accountants out there that say that you shouldn't be doing that. And that's fair enough. Take your advice from your accountant. But my accountant, and I'm doing this, is that I'm taking that money out of the limited company as a director's loan to myself, but then I'm paying it back before the year end, 0 interest. But in the months that I've taken it out of the limited company account, because I don't need it on a day-to-day basis and it's not really working for me, I can be making that money work really hard and smart for me and saving me all that money. So look, I'm hoping I'm giving you some food for thought here about how you can use perhaps spare cash and use it in an offset type environment. Now, the innovations come with the new lenders coming in because you can be making these savings in an offset account, even if your mortgages are in a limited company. Historically, these have only really been available if the mortgages have been in personal name. So now we've got that added opportunity to have an offset, even if you've got a limited company mortgage. And as I've said on the 4th bullet point, as a landlord, if you've got buy-to-let mortgage or a HMO or a holiday-let mortgage, then potentially that's still applicable and you'll be eligible for an offset mortgage for those types of mortgage products. So the takeaway message is talk to your broker, understand what sort of products, what interest rates are these buy-to-let offsets looking like, and then tell your broker the sort of savings that you might have on average, and he or she should be working out, yes, you've got a headline rate of, let's say, 5%, but if you've got X pounds in savings potentially over a year, then your broker will say, well, that actually means an effective rate that's substantially lower. And that could be the best news you've heard. Rather than paying that headline rate of 4, 5, 6%, you might be paying 1, 2, or 3%. How smart is that? So if you want to chat certainly to us, then there'll be a link below this piece that takes you through to our diary, and just have a chat with the team. Ask them about offsets. Is it right for you? In this piece, I want to talk about halving your life insurance premium. Now, come on, you're saying, surely we can't do it. That's some, ridiculous headline here that can't be true. But genuinely, there's some significant savings up to 50%, depending on your circumstances. But you've got to be eligible. So here's the first thing. Do you own a limited company? And I don't just mean the trading limited company. What also is applicable are those of you that own a limited company where your investment properties. So if you have a limited company, an SPV, special purpose vehicle, and you've got investment properties in there, then you will be eligible for these improved life insurance premiums that are going to be cheaper than if you're paying those premiums in your own name. Because this is how it works. As it says here on the third bullet point, the premiums are not paid by you, they're paid by your limited company. That's the first thing. And because they're paid by the limited company, not you, then they can be treated as a business expense. Good old HMRC have actually approved to say that you can take those premiums and treat them as a taxable business expense. So if normally you are paying £20, and yes, this is monopoly money, if you're paying £20 for your premiums out of your own pocket, then because now you can pay those premiums out of the company bank account and it's treated as a business expense, what does that do? It reduces your profits, and therefore it reduces your corporation tax. So you're paying less for your life insurance because your corporation tax bill is less. Who doesn't want to save money? Now, gets even better than this, because here's the thing. If you happen to be paying yourself a salary out of your limited company, the savings get even bigger. Why? Because now, instead of you paying that £20 out of your own pocket, because how do you get that 20 quid? You've paid yourself a salary. So for that to be 20 quid, you've had the company probably had to have had 40 quid, because it, first of all, pays national insurance, employee and employer's national insurance. And then there's income tax that you've got to pay. So for you to have £20 in your pocket, you had to start with perhaps 40 quid that you're paying money out in tax, so you end up with 20 quid after tax in your pocket to then pay the life insurance. So the savings, if you pay yourself a salary out of your limited company, and of course you are paying those premiums out of your own pocket, then there's a double saving for you to be had. So please, 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 if you've never done this before, if you're paying your life insurance out of your own pocket, if you have a limited company, speak to the team, speak to Victoria at the office. She will explain how this works in more detail. She'll give you more literature. She'll tell you if you're eligible, and you can be enjoying those savings. And here's the thing, with life insurance, hopefully, you're paying life insurance for not just the next year or two. It could be for 10, 20, 30 years that you're making these savings. The savings are going to be substantial over the longer term. So even if the savings, oh, well, that's only a 5 or 10 quid a month, then extrapolate that over 10, 20, 30 years. And then hopefully that will motivate you, put fire in your belly to make some decisions, put a little bit of time in to see if those savings are right for you. So I really hope that's been of use to you today. And as I said, If you want to learn a little bit more, then click on the link before and just have a chat with Victoria, and she'll help you along the way. And finally, it's just a quick oversight of the services that we offer. So, for existing and new clients to the mortgage home, here's a list of the services that we offer. As you'd expect, everything to do with bricks and mortar, long-term mortgages, short-term, development, bridging, and of course, the various types of insurances and protections that are out there. We're a whole of market advisor and we'll be delighted to help. But for now, that's it for this month's update. I hope you have a fantastic summer and I'll see you on the next update.